Hello ACCA MOXIE students. Now we have finished our lectures. So I'm going to start the risk management questions we will solve together. Okay. So let's do. The one is, what does the term matching refer to? Matching means the inflow and outflow. Matching the inflow and outflow of same currency. Okay. For example, if you have pound, you have to match with the pound. Okay. So, or I can say that matching asset and liability. Okay. So mechanism where company the coupling of two simple financial instruments to create a more complex one. Okay. Coupling of two simple financial instruments to create a more financial one. No. Mechanism whereby company balance its inflow and outflow. Yes, inflow and outflow. So the adjustment of credit terms between company, adjustment of credit terms. No, the contract not yet offset by futures contract or fulfilled by delivery. No. So matching is inflow and outflow. So this is the correct answer. Okay, we have to select only one. So this is the right answer. Okay. Next is, a company whose home currency is dollar expects to receive for 500 peso in 6 months time. Oh, this is we already done money market hedge question in our lectures. The same question we already done during our lecture for foreign currency risk management. So you can watch over there if you haven't yet. So let's move on to next. The next is acted company whose Spanish supplier has to pay, right? Pay to Spanish supplier under euro in 3 months time. The company finance director wishes to avoid exchange rate exposure and is looking for 4 options. Okay. Indicate by clicking in the relevant boxes whether the following provide cover or not. Okay. Exposure would otherwise suffer. Okay. Provide cover or not cover. Okay. Do nothing for 3 months and then buy euro at the spot rate. It means provide cover. No, it will not provide the cover. If you don't do anything, then you buy at the spot rate, then you still face the exchange rate risk. Okay. So not provided has pay in full now and buy euro at today spot rate. Yes, pay in full now. This means this is leading. Leading is a traditional way of hedging the risk. Yes, traditional way of mitigating the risk. Okay. And buy euro now and put them in the deposit for 3 months and pay the debt with the euro surplus plus accumulated. Put them in the deposit for 3 months and pay them with the deposit and pay the debt with the euro accumulated. Yes, this is what? This is matching. Yes, this is the matching, right? Arrange forward exchange contract to buy the euro in 3 months time. Arrange a forward exchange contract to buy the euro Okay, next is the arrange a forward exchange contract to buy euro in 3 months time. This is forward rate agreement. So forward rate agreement forward exchange contract. Sorry, forward exchange contract. This is forward exchange contract because for currency, for foreign currency risk, for foreign currency risk, forward exchange contract, and for interest rate risk, forward exchange rate. Okay, so this is the right answer. Would cover the X. Okay, indicate by clicking the relevant boxes whether the following statement is currency risk is true or false. Okay, lagging is a method of hedging risk exposure. Hedging risk exposure, no, because 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 lagging is not a hedging technique. Lagging is not a hedging technique. Is a traditional way of mitigating the currency risk. Okay, so and in lagging you don't need to go to bank or stock market. So in lagging, no need to go to bank or stock market. But for hedging, you have to go to bank or stock market. So lagging is not a hedging method, right? Matching receipt and payment is a method of hedging translation risk. No, receipt and payment matching is a hedging transaction risk. Not the translation risk. Translation risk can be managed by diversifying our operations in different currencies, right? So this is false. A UK company has just dispatched a shipment of goods to Sweden. The sale will be invoiced in Swedish kronor and payment is to be made in 3 months. Okay, neither the UK exporter nor the Swedish importer use the forward exchange market to cover the exchange rate risk. If found weak if found weak substantially against the euro dollar and the forward exchange contract, gain or loss upon the UK exporter and Swedish importer indicate by clicking the reference. If the pound will depreciate, will the UK exporter gain or loss, or Swedish importer gain or loss? Okay, if the UK exporter is paying, if the UK exporter receiving the foreign currency, so if the UK exporter receiving the foreign currency and his domestic currency, home currency depreciate, which means increase in foreign currency. So Swedish krono will increase, which means they are getting the higher stronger currency. So it is a gain, getting stronger currency. So this is a gain for the exporter, but for importer, because the invoice is in Swedish krona, so importer has to pay same amount regardless of increase or decrease. Okay, so there is no effect on the importer. A UK company will purchase new machinery in 3 months time, 3 months time at 7.5. The forward exchange rate is this. Okay, purchase means pay, right? So when you pay, so when you go and convert, you divide, you divide, you divide, dividing by higher, dividing by higher rate will give lower amount, but dividing by lower rate will give dividing by dividing by lower rate give high amount. So when we go and pay, we have to pay more, but when we receive less, right? So we always at the worst rate. So when we pay, we divide with lower rate, but so that the amount is higher. But when we receive, we divide it by higher rate. We already studied during our lectures. So which rate should we choose? This one. Okay, this one 2.0383. Okay, what should be the the current spot exchange rate between sterling and the euro is this spot sterling interest rate is this and euro is this. Okay, so what is the 3-month forward rate? Okay, 3-month forward rate 1.4 1.4415 multiplied by, we have to divide it by 5.75 divided by 100 and multiplied it by 3 divided by 12, because it's a 3-month, right? After 3 months. So how much we will get? We will get 5.75 divide 100 full multiply 3 divided by 12. Okay, we will get, so you know what is the formula? 0.0118 0.008. Okay, this one is the euro. Okay, sorry, we have to multiply it by the, let me write it for you. The formula is spot rate multiplied by the currency. If the currency, this is euro, if the euro is in the numerator, then the euro interest rate euro interest rate okay, euro interest rate will be high, will be in the above, and the pound interest rate will be in the numerator denominator. Okay, so 4.75 divided by 100 multiplied by 3 divided by 12. Okay, how much? 4.5 divided by 100 divided by 3 divided by 12. 1 point, and we do 1 plus. Okay, this is the interest rate parity, right? Interest rate parity. So 11875 1 point 14375 a 4. 1.4379. This is the forward rate after considering the interest rate parity theory. Okay, fill in the gap in the sentence below. Okay, the difference between the price of a future contract and the spot rate on a given date is known as spot price and the future price. Spot price and the future price. The difference is basis. Okay, the difference is due to basis risk. Okay, choose which of the following: initial margin, no; basis, yes; hedge, no; premium, no. Next is which of the following statement is correct. So the following statement is correct. Once purchased currency futures have a range of closeout dates. Once purchased currency future is a exchange traded, right? Exchange traded, which means which means is a standardized contract. In a standardized contract, you have standard amount, or you can say fixed amount, time, and quantity, right? Amount, time, and quantity. So if these are fixed, amount, time means amount, time, you can say date are fixed, expiry date is fixed, and the quantity, right? So the closeout date are not a range of dates. These are March, June, September, December. Okay, so this is incorrect. A currency swap can be used to hedge exchange rate risk over a longer period than the forward market. Currency swap can be used to hedge exchange rate risk over. Swap is used for hedging risk over a longer period. Yes, this is correct. Bank will allow forward exchange contract to lapse if not used by the company. No, it's an obligation. It is an obligation, not the option. So this is incorrect. Currency options are paid when they are exercised. No, a premium is paid when taken or bought. When you take a bought, you have to pay the premium and it is upfront. So this is incorrect. So the correct answer is this, B. 198. Which of the following are held by Francis company at their expiry date? Which of the following options held by at the expiry date? A call options, which means this is call means right to buy, right to right to buy, okay. So right to buy, this is used by importer when they pay for the currency, right? So when they pay, they buy the call options. Okay, on 500 pound, he has to pay at an exercise price. If they pay, he has to pay 500 exercise price. So he right now he has to give 1.9, but at the expiry he has to give 1.95. So it will it will exercise the contract right now. Okay, it will exercise the contract because right now he has to pay only 1.90 $1.90 for getting 1 pound, because he has to pay in pound. So his home currency is dollar, and right now he has to pay only 1.90 to get $1, but at the expiry he has to pay 1.95. So right now he will exercise the contract. Okay, he will exercise the contract. He will exercise the contract. Put options. When you buy a put option, when you right to sell, if you are receiving what you will sell, you sell the euro. Okay, so you sell the right to receive the 400, because you are a exporter in exchange for contract at an exercise price of, right now you have to pay, right now after getting Singapore dollar, you will get $1 by paying how much? Right now you will receive okay. So call option means right to buy right to buy this currency. Okay, so when you buy, so right now at this exercise price, you will buy you have to pay 1.90 to buy $1. Okay, right now you have to pay 1.90, but at the expiry date you have to pay 1.95, which means you are paying higher at this rate. So you have to exercise the contract. Okay, you have to exercise the contract. Okay, so call option means right to buy, right to buy 500 pound in exchange for US, which means you buy this and you pay US dollar. Okay, so you right now you will pay how much? You will pay USD 1.90. you will pay $1.90 now. At now exercise price, now you will pay 1.90, but at the expiry date you will pay 1.95, which means at the expiry date you have to pay higher, so you will exercise the option. Okay. But next is put option. Right to sell. It means right to sell. Which currency? This will you sell, and this one you will buy. So right now you have to you have to you will buy. Right now you have to, at the exercise price, you will have to, you can only buy by selling £1. By selling £1, you can only buy 2.90, but at the expiry date you can buy 2.95. Okay, by selling £1 at the exercise price, you can get 2.90, but at the expiry date, by selling £1, you can get 2.95. So you will lapse it, right? So you don't exercise the option, instead you will lapse the option. Okay. Next is AD company. Okay, AD company. AD company is a UK that imports furniture from Canadian supplier. So Canadian supplier and sell it throughout the Europe. AD company has just received a shipment of furniture invoiced in Canadian dollar. So pay in Canadian dollar. Okay, for which the payment is to be made in 2 months time. Okay, neither AD nor the Canadian supplier use hedging technique to cover the risk. So if the pound sterling were weakened, which means our redux home currency which is pound reduced, which means increase in foreign currency, because we are an importer. So increase in foreign currency and invoice in foreign currency, so we have to pay the Canadian dollar, which is foreign currency, and are appreciating, which means we have to pay higher. So for us this is loss. But because Canadian supplier is invoiced in Canadian dollar, they will receive the same amount, whatever the exchange rate. Okay. Indicate by clicking in the relevant boxes whether the following statement true or false. Okay. Impact on the value of currency. About the impact of fall in value of country's currency. Okay, if fall in home currency, what will happen? Increase in export. Why increase in export? Because domestic product becomes cheaper. Why they become cheaper? Because the one unit of foreign currency can get more home currency, right? So export will increase, the rate of domestic inflation will rise. No effect. Why? Because inflation is not, the rate of domestic inflation will rise. No effect, because invoice in, sorry, okay, sorry. My bad. So the rate of domestic inflation will rise. This is right. This is purchasing power parity. Purchasing power parity. What purchasing power parity says? Purchasing power parity says increase in inflation means the country whose currency has higher inflation, their their home currency reduce or at depreciating rate, which means this is also true, right? Due to purchasing power parity. Okay, next is which of the following statement is true of a put option? It is right put option. Put means sell, right to sell. So it is the right to sell the asset at a fixed price. Yes. It is an obligation. No. Right to buy. No. Right obligation. No. So this one is the correct answer. Okay. The following statement refers to an interest rate risk. Are each of the following statement true or false? Okay. Are each of the following statement true or false? The aim of forward rate agreement is to lock companies into a target interest rate. Lock, yes. Forward rate agreement lock the rate and has both adverse and favorable interest rate movement. Yes, if you gain, you have to pay, but if you lose, bank have to pay. So you are protected against both in both the situation. Okay, so this is the true, right? An interest rate guarantee is more expensive than forward rate agreement. Yes, yes, because option comes with the cost is premium. We have to pay the premium cost to buy the option. Or interest rate guarantee is an option on forward rate agreement. So, and as one of the advantage to pay the flexibility to be able to take advantage of favorable interest rate moment. Yes, true. Okay. The following statement refers to interest rate future. Future is exchange traded. Okay, exchange traded. Remember, exchange traded. Are each of the following statement true or false? If you sell a future contract, you have a contract to lend money. If you sell a futures contract, you have a contract to lend money. No, you have a contract to borrow money. Sell futures, which means you have a contract to borrow money. So this is false. Each contract is for a amount standardized amount with a set maturity, and the number of contracts must be dealt with. Yes, true, because it is exchange traded and it is a standardized contract in which the amount, time, maturity is already defined. Okay, so first one is false and second one is true. The shape of yield curve at any point in due to result of three theories acting together. Okay, which of the following theories not influence the yield curve? Liquidity preference theory. Yes, because due to liquidity preference theory, the shape of yield curve is is like this, upward sloping. But due to expectation theory, the shape of yield curve is is downward sloping. Okay, so these are the theories that influence the yield curve. Flat yield theory. No, flat yield is the shape, not the theory. Flat yield is the shape of the curve, not the theory. So this is not. Market segmentation theory define 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 the shape, define the flat shape, flat shape or humped shape. flat safe or Humphrey safe, because it is depends on demand and supply. Depends on demand and supply. Okay, so flat yield theory is not, flat yield curve is the main, is the flat yield theory is nothing but it is the shape of the curve that is flat due to market segmentation theory. So these are all. So okay, this is not true. This is not true. All these are three true. Yes, these are humped curve. Okay. So the following is shown by a yield curve. Relationship between liquidity and bond interest rate. Yes, relationship between time of maturity and return on bond investors. Okay. Okay, so next is the which of the following is shown by, so the following is shown by a yield curve. Okay, so on yield curve, on one axis we have return, that is we call yield, return or yield rate, which is yield rate is the return rate to the investor or lender, and the other side we have the maturity time. We have maturity time, right? So the relationship between liquidity and bond interest rate, no. And bond interest rate, no. It's not the bond interest rate, it is the return to the bond holder, right? The relationship between the time of maturity and the return to bond investors. Yes, relations between risk and interest rate, no. The relationship between bond interest rate and bond prices, no, there is no price on this variables. Okay, so B is the right answer. So next is, which of the following measures will allow UK company enjoy benefits of favorable change in exchange rate to their euro receivable contract while protecting them unfavorable exchange rate movement? Okay, euro receivable, protect unfavorable but take benefit of favorable but protect against unfavorable. So this is option according to me. A forward exchange contract, no. You have to execute the contract, right? Have to execute the contract at the set price, so you cannot take advantage in both cases. So this is not right. Have the, because have the option, right? Option, yes, option, but which one? Because you are receiving, so receiving means you will sell euro when you receive. So you will buy the put option, right, to sell the euro, right to sell. Okay, so this one is the right, but let's read next. The call option, no. Money market heads, one is the right. Next is the, which of the following statement is correct? So the following statement is correct. Government may choose to raise interest rate so that the level of general expenditure in the economy will increase. No. Because increase in interest rate on borrowing borrowing reduce make loan expensive and this will lower lower down lower down lower down the money in hands. So make loan expensive, so people will not, or I mean say people will not borrow, so they have less money and less money in the hands of people, so less spending power. Okay, so expenditure in the economy will will decrease, right? The normal yield curve slope upward to reflect the increasing compensation to investors for being unable to use their cash now. Yes, unable to use their cash now. This is the liquidity preference theory that says that increase in compensation is due to unable to use their cash now. Yes, this is correct. The yield on long-term loan is lower. Yield on long-term loan is lower than the yield on short-term loan notes because long-term debt is less risky for a company than, oh no, long-term loan is more risky because for example, if your friend wants to borrow, if your friend wants to borrow for 1 month from you, then you will give instantly. But the same friend wants to borrow you for 2 year or 3 year, then you will definitely ask more questions, and sometimes you will try to avoid giving the loan, right? Avoid giving the money to your friend. So it's why? Because the longer the duration, longer the risk that the person you are giving the loan may not pay the loan, because future is uncertain, and in the future, right now he has money, but in the future your friend may not have money and he may not pay the loan, right? So long-term loan is more risky. So this is not. Expectation theory states that the future interest rate reflect expectations of future inflation rate. No. Future inflation rate. No. Interest rate. Expectation theory says that the future interest will reduce. Future interest rate will reduce. That's why the lenders will try to reduce the interest rate, so that because right now the lenders will try to reduce the loan, so that their loan rate will be reduced in the future. That's why they are lowering down their interest rate. Okay, so this one is the right. Interest rate parity theory generally holds true in practice. However, it suffers several limitations. So limitation of interest rate parity theory. Okay, which one of the following is not limitation of interest rate parity theory? Not a limitation of interest rate parity theory. Government control interest rate. Yes, this is one of the limitation, right? This is one of the limitation. Okay. Controls on currency trading. Yes, because interest rate control control on currency trading as well. Yes. And intervention of foreign exchange market. Yes. Yes. Future inflation rates are only estimates. Future interest rates, inflation rates are only estimates. Relates to purchasing power parity, not interest rate parity. So these are the limitations, and this one is the relate to purchasing power parity. So this is not the limitation, right? So this one is the right answer. Which of the following are description of basis risk? So the following are description of basis risk. Is the difference between spot and future exchange rate? No, this is not the difference. It is the possibility that movement in exchange, future price and spot price and exchange different. Yes, yes, this is the right. This is difference between fixed and floating interest rate. No, it is nothing related to fixed and floating interest rate. It is one of the reason for an imperfect currency future hedge. It's one of the reason for imperfect currency hedge. Yes, due to imperfect currency, the spot the the basis risk may not equal the spot rate. Yes. So 2 and 4 is the correct answer. Okay. Which of the following data is available? Okay. What is the 6-month forward exchange rate in country Y? Forward exchange rate 6 months time. So these are the interest rate. So this is the interest rate parity theory question. So how can we calculate? We will take this. We have this I think spot rate. What is the formula? Spot rate multiplied by 1 plus remember, if this is the here is the peso, so the interest rate will be the one who is the peso, interest rate of peso. Oh, and here interest rate of the dollar. Okay, so I will, this is the peso, so the interest rate 1 plus how much we have to divide. This is the peso, right? One is the peso. X currency x 3 divide 100 multiplied 3 divided by 12. Sorry. 6. 3 divide 100 divided by 2.015. Okay, 0.15. This one 1 divide 100 multiplied 6 divided by 12. How much? 5. And this one 1 divide 100 by 2. 0.005. 0.005. 1.015 multiplied 1.6 by 0.05 and 0.6159 1.6195 0.6195. Can say that 1.6159 0.6159, or I can say 1.62, or I can say 1.62 as well. Okay, This is interest rate parity question, right? Just remember this formula and you will understand. And the most important, if you have peso here, then the upper currency, the interest rate should be the peso, and the next alternative currency should be in the denominator. Okay. Okay, next question is indicate by clicking in the relevant boxes whether the following statement about interest rate risk hedging correct or incorrect. Okay, an interest rate floor can be used to hedge an expected increase in interest rate. Floor protect hedge against increase in interest rate. No, floor protect against decrease in interest rate. So this is incorrect. Okay, the 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 cost of an interest rate floor is higher than cost of an interest rate collar. No, this is also incorrect, because the in floor we what we in floor we pay interest. Okay, in floor we pay premium for buying the floor. In floor we pay premium for buying the floor, but in collar we pay premium but at the same time we receive premium as well. So it means the premium paid and received offset each other, and the transaction cost is very low in the collar. Okay, so floor is more expensive than collar. Okay, so this is incorrect. Okay, the premium on an interest rate option is payable when it is exercised. No, it is paid when it is taken or purchased, not when it is exercised. So upfront cost, upfront cost in option we have upfront cost. Okay, so this is incorrect as well. The cost of interest rate floor is higher floor is higher than the collar. Oh, actually this is right. I already explained that the floor cost is higher than the collar. So this is correct. Okay, the standard nature of interest rate futures means that over and under hedging can be avoided. Over and under hedging using standard nature of futures contract. Futures over and under hedging can be avoided. No, because due to standardized contract we have to buy a specific amount of the future size. So our hedging, sometime our hedging is higher, sometime our hedging will be lower. So exact hedging is not always possible. Okay, so this is incorrect. Next, Brass Company has produced a cash forecast that predicts a cash shortage. Okay, cash shortage of 5 months. Cash shortage, how long it will stay? 5 months, starting in 4-month time. Okay, starting in 4-month time. It has noted the following forward rate agreement, FRA, following forward rate agreement available from the bank. Okay, available from the bank. It is a OTC, so you don't need to worry about this. OTC. Okay, it is a forward rate agreement, so it means start at the 4 months. So start in 4 months, right? And how many months it will be for 5. So 5 plus 4 plus 5 means 9. Okay, so it must be start in 4 months and stay for 9. So this is wrong. This will start in 3 months, but it has to start in 4 months, right? 4 months. Okay, this is not, this is right, but it has to be for 5 months. So you can calculate by this. 4 minus 5 equal 1, or 9 minus 4 equal 5. So it will be for 5 months. It will be for 5 months. So this one is the correct. Okay, this forward rate agreement we have to choose. Okay, so next go indicate by which forward rate agreement would be used, and which FRA and which rate would be fixed if RAS company took on the most appropriate FRA. Okay, so which FRA for 9 and which rate, because we have a cash shortage, so we have to borrow, right? We have to borrow in order to pay, right? We have to borrow in order to pay. Okay, so we are borrowing, and if when bank charge higher interest when we borrow. Okay, bank charge higher interest when we borrow, but bank give lower interest when we invest. Okay, lower interest. So which rate is applicable here? Which rate is applicable? 4%. Okay, next is Plum Company, a company based in New Zealand, has entered into a contract with Japanese company purchase an item of machinery. Okay, purchase means he has to pay. Okay, pay the cost of Japanese yen. It means it has to pay in yen. Okay, foreign currency, and paid in 6 months time. Has to be paid after 6 months. After 6 months, decided to enter into a forward exchange contract. Okay guys, so remember this is foreign exchange risk question, and forward exchange contract. Okay, it is similar to forward rate agreement question. Okay, so who has offered a contract at the following 6-month rate? Okay, so calculate to the nearest dollar the value of New Zealand dollar that would be needed to settle the purchase invoice if the forward exchange contract is used. How much New Zealand dollar we need to pay? Okay, so we are paying. Okay, so how much we are paying? We are paying how much yen? This much. So this is yen, so we have to divide it by yen. But which rate we use, and you can say we can multiply it by 1, or we don't need to multiply because answer will be the same. Okay, so which rate we have to use? We have to use the lower rate, because dividing by lower rate we get higher amount. Okay, dividing by lower rate we get higher amount, because in case of payment we pay high, in case of receipt we receive less. Okay, so dividing by lower rate we receive, sorry, we will get higher amount, so we have to pay higher amount. So how what is the answer? 5181 is the answer. Okay, next, the expected spot rate in 1 year is this. Okay, and predicted inflation rate is this, euro and dollar. Okay, just remember this is very simple. This is purchasing power parity. What it says? It says that in a country which has higher inflation, if a country has higher inflation, its currency will depreciate. So by using this we can calculate the forward rate. Okay, we can calculate the forward rate. Okay, so what is the spot Okay, expected spot rate in 1 year. Okay, okay. So okay, let me write the formula. Okay, current spot rate. Okay, current spot rate multiplied by 1 plus 1 plus, if this is the euro, if this is the, sorry, if this is the euro, then this has to be euro currency. Okay, and the expected spot rate, this is expected euro currency inflation rate. Okay, and dollar currency inflation rate. Okay, expected spot rate. So generally we have to calculate the expected spot rate, but in this question we have given the expected spot rate. Okay, and we have to calculate the current spot rate. Okay, so 1 point, this is also in euro, right? This is also in euro, 1.4505. Okay, we have to calculate current spot rate multiplied by 1 plus 1 plus, so how much? 2 divide 100, how much? 0.02, and 3.5 divided by 100, 3.5 divide 100, 0.035. Okay, 0.035, 0.02, because it's 1 year. Okay, it's 1 year, so we don't have to multiply it by 3 divided by 12 or 6 divided by 12. Okay, because it's a 1 year. Okay, so 0.035. First I'm going to current spot rate multiplied, I'm going to divide it by 1.02 divide 1.00035. Okay, so what is the answer? The answer is 0.9855. Okay, 0.9855, 1.4505. Okay, so we have to divide it by 1.4505 divided by 0.9855. Okay, and this is the current spot rate. So 9.9, 1.4505 by 1.9855 equal 1.47. Current spot rate is 1.4718, 0.4718 euro per dollar. Okay, which two of the following statement, which two, okay, following statement concerning the interest rate risk management is true? Which two are true? The debt portfolio will consist a mixture of fixed and floating rate debt. Okay, this is true. Following statement concerning interest rate risk management. Okay, if our debt portfolio have fixed and floating rate, which means we can manage the interest rate risk. This is right. Okay, this is right. Interest payment will still increase if interest rate rise. Yes, because we have variable, because we have floating rate, if floating rate increase, our interest interest expense will increase. So this is true. Okay, so next is investment with a fixed cash flow will be financed with fixed rate debt. No, 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 this is matching, okay, this is matching, not smoothing. This is we are in relation to smoothing, but this is related to smoothing. Okay, full benefit will be obtained from a fall in interest rate. No, because because even if the interest rate fall to zero, we have a fixed rate obligation, and we have to pay the fixed interest. So our interest, full benefit cannot be obtained by fall in interest rate. Okay, the net effect will be an interest payment which is fixed over all. The net effect will be an interest payment which is fixed over all. No, because we have floating rate, so there is not always that we pay fixed payment. So this is also incorrect. So A and B are correct. Okay, a company that has 14 million loan with a variable rate of interest has acquired a forward rate agreement with a financial institution that offered 4 to 11 forward rate agreement start in 4 months and will be stay for 11 till 11 month. How long it will be? 11 minus 4, it says 7-month loan. Okay, 7-month loan. Okay, so which rate? Higher rate is applicable for the loan, because for borrowing higher rate. Okay, what would be the amount received from financial institution under the terms of forward rate agreement? So what is the forward rate agreement? In case of forward rate agreement, we go to bank and fix a forward rate. So this is the forward rate given by the bank. If the spot rate, if the actual rate of interest, if this is the spot, if actual interest rate on the date will increase means bank will pay us. It means we will receive from the bank. And if this interest rate, for example, go like 2%, then we have to pay, because forward rate agreement is not a way of making profit, it's just a way of hedging the risk. Okay, so right now the actual interest rate is 3.75, so we have to pay at 3.75, but we have to only pay the 2.85 interest rate. So how much is the difference? This difference we will receive from the bank. So how much is the difference? The difference is 3.75 minus 2.85 for 0.9%. okay, this one is we will receive from the bank 14 million. 0.9% multiplied it by how many months for the loan? 7 months. So 14 multiplied 0.9% multiplied 7 divided by 12. Okay, so we will receive 0.0735 million. So when we convert it into the into the full digit. So how much? 73,500. Okay, $73,500. Okay, this amount we will receive from the bank. Okay, receive from the bank, from the financial institution, because we are paying higher, but according to forward agreement we have to pay 2.85. so the difference we will receive, but if this is lower then we have to pay. Okay, so this amount we will receive. I think you can understand this. Just guys, you need to solve all these questions once, and you are very comfortable with this type of questions. Okay, next is which two of the following derivative instrument are characterized by standard contract size? Okay, which of the derivatives are forward rate agreement, forward contract? Okay, forward rate agreement, forward contract in case of foreign currency. Okay, future option. Okay, future option. These are the standardized contract, because exchange traded. Okay, exchange traded. So this of the standardized contract for forward contract. Okay, sorry, standardized contract, exchange traded, but forward rate agreement and for foreign currency are not standardized contract, because they are not exchange traded. Okay, so forward contract is OTC, not the exchange traded. So OTC is customized contract. Okay, forward rate agreement also OTC, so customized contract. Okay, so this is again the wrong answer. Futures contract. This is right, because this is exchange traded, and this is the standardized contract. Okay, swap is again between two parties, and it is the OTC. So this is not over the counter, no exchange traded contract. Yes, because these are two standardized contract. Okay, the next is which of the following is a description of gap exposure? So gap exposure means difference between short term and long term interest rate. No, gap exposure means the difference between the asset, a group of asset and liabilities that mature at a point in time. If the value of these asset and liability is higher than if there is any difference, then this difference is called gap exposure. Okay, so this is not the difference between interest sensitive asset and liabilities. Yes, asset and liabilities, this is difference is called gap exposure. Yes, the difference between spot interest rate and future spot rate, no. Difference between fixed and floating interest rate, no. Difference between asset and liabilities at a point in time, and this difference is called gap exposure. Okay, which of the following statement about OTC are correct? So the following statement about OTC are correct. It is an agreement with a financial institution. Yes, because OTC is between two parties and one is the financial institution. Okay, this is right. It is traded. No, OTC is not traded. An immediate premium is payable. In case of immediate premium is payable. Yes, in case of option, we have to pay. It must be exercised. it must be exercised. It must be over the counter option. Yes, yes, premium and immediate premium is payable if OTC option. This is, remember, this is OTC option. Okay, so a premium has to be paid on the option. Yes, this is right. It must be exercised. It must be exercised. No, you have the obligation. Sorry, you have the right. You have the right, not the obligation. Okay, in case of option. So 1 and 3 is the correct. Okay, which two of the following hedging technique can be used by an investor to protect which of the following hedging technique can be used by investor to protect against fall in interest rate? Because decrease in interest rate will decrease the income of the investor. Okay, so this is the risk for the investor. So how can they manage? They manage by money market has used money market hedge. Money market hedge is for foreign currency risk management. It's not for interest rate. Okay, so this is not right. So interest rate collar, yes, you can use interest rate collar. And interest rate cap is against increase in interest rate, but we want to has the risk against fall in interest rate. Okay, fall in interest rate. So floor protect against the fall in interest rate. So this is correct. So D is correct and interest rate collar is correct. Okay, collar protect against both increase and decrease. Okay, so I hope guys you understand all these questions.
Hey everybody, my name is Neeraj and thanks for watching. If you are benefited from the lecture, consider like, share and subscribe. If you have any questions, leave them in the comments below. I will meet you in the next video.